Ladies and gentlemen, it gives me a distinct pleasure to introduce again Mr. Joseph Cipolla with Wofford Capital Partners and Mr. Nick Roos, Managing Director with Maritime Asset Partners. Joe, we were earlier on a panel. If you do not mind, could you please give us a brief introduction of you and Wofford, just to remind the audience of who you are?
Is it on?
Yeah,
Okay. Well, thanks, Basil, and thanks for having me here again. By way of introduction, I'm Joe Cipolla of Wofford Capital Partners, as well as Maritime Asset Partners. Wofford Capital Partners is a asset management firm, majority owned by the Public Institution for Social Security of Kuwait, which is pretty much exactly what it sounds like. It's the Kuwaiti pension system. We invest capital both on behalf of our majority owner as well as other Gulf-based financial institutions. Our primary mandate's asset-backed finance, and we've been active investors in shipping since around 2010. One of our most recent efforts has been, after, let's say, doing some opportunistic transactions over the years, we decided to make a bit more of a concerted effort in ship finance, and created, together with a group of Norwegian ship owners and financiers, Maritime Asset Partners, and convinced Nick to join us as the head of that platform. And that platform's kind of really, our primary vehicle, let's say, for our ship financing efforts.
Thank you. And Nick, could you please give us a brief introduction?
Sure,
yourself?
yes. Thanks very much, Basil, and hello everybody. Hello, my name is Nick Roos. I'm Managing Director at Maritime Asset Partners, as Joe said. We've just celebrated our first anniversary, so we're 12 months into this now. Maritime Asset Partners is a non-bank lender into the maritime space across all asset classes. And across all geographies. We have a very broad mandate from the shareholders to deploy capital into the shipping industry, covering structures, everything from traditional first lien lending into the kind of markets that the international shipping banks have traditionally been very active in. But then we can also look at higher risk profiles into subordinated senior junior debt structures. We're active in the sale leaseback space. It seems very fashionable all of a sudden this year. So we're active as lease equity in those transactions. All of the business that we're doing in that kind of area these days is bareboat structures. We're not set up for time charters just yet. Who knows, one day we'll get there. But then all the way through to structured equity products into sort of corporate holding company financing, pref issues. We can issue debt on traditional bank loan paper. We can buy bonds. Frankly, it gives us a lot of flexibility to offer money into the industry. We're looking at transactions anywhere from, call it $8-9 million. We're still testing the upper limits of that. We've looked at some very large transactions, and the broad shoulders next to me haven't been tested too far yet, so we'll keep going until we find the end of that.
Yeah, on that note, we're more focused on finding good transactions and, pleasantly, and knock on wood, not really burdened with capital constraints. In terms of deploying capital into good deals in the industry. So we look forward to Nick testing us.
Thank you. So in a couple of words, what is the big difference from a practical point of view, from the borrower's point of view, between your platform versus approaching and getting a mortgage from a shipping bank? Any major differences, efficiencies, what the client sees?
Yeah, and maybe we could both answer this, but I think Some of the things that come to mind are speed of execution. I think we would probably beat many, traditional banks, at least from what I understand. I think we have a degree of flexibility in terms of what we can offer, whether it's a traditional first lien loan or sale leaseback or some sort of structured or preferred equity. So I think there's flexibility in transaction types that may not be present certainly at a traditional bank. And you have folks who are kind of dedicated to the space, knowledgeable and creative. Maybe Nick, if you have anything you want to add to that.
No, I think that's exactly it. At the end of the day, if we are looking at a first mortgage transaction, the documents that we would work from and the terms and conditions in those documents will look remarkably like what you'd expect to see from an international shipping bank. The key differences, I think, as Joe has already alluded to, is that the process that we operate from is much more streamlined. We have very short reporting lines, and we can turn stuff around. We have turned stuff around in a week. Now there's a lot of work to do before we get to that sort of board presentation, but we're not burdened by excessive policy-driven constraints in transactions. I like to think that we take perhaps a more commercial view of the assets that we're financing here. And rather than starting, at the end of the day, this is a credit fundamentals business. We're looking at assets, we're looking at cash flows, we're looking at management teams, and at the end of the day, we're all trying to manage residual value risk 4, 5, 6, 7, 8 years down the line. Whereas most of the international banks, forgive the generalization, but most of the international banks start from the corporate and they start from the relationship and what can the wider bank business pick from the relationship, cross-selling into other products. We have one product, and that's our balance sheet. And so for us, the most important starting point is the underlying assets and the cash flows and the break-even. Is that right? Is that better? And in that respect, I think that does create a difference for us in the way that we approach the market and the way that we approach the structures. We will, for instance, look at much longer amortization profiles, which creates a lot of cash flow savings from capital amortization. And we will look at older vessels. I think another important distinction there. That's how we'd separate ourselves.
Thank you. And what's the price for that? You mentioned you are more efficient than a bank. You can move faster than a bank, a streamlined process. I suppose there is a cost for that, or in other words, what is your cost of capital for most of the type for a generic type of transaction you most likely would do? Yeah, look, I mean, that's one of the things that sadly we're not flexible on. We're not there to chase the market down to buy market share. Our capital and our shareholders have return expectations, and our job is to find the deals that work around that. Now, it's important, I think, to note that in general what we're doing here is we're deploying fixed rate funding. So we're rather benefiting at the moment from the increasing interest rate environment. And certainly the gap between what we are doing and what the LIBOR-based shipping banks are doing is narrowing. But for sure, there's a gap. And we recognize that in order to achieve those kind of returns, we need to take the risk that's associated with that. So we will do the higher loan-to-values, we'll do extended amortizations, and we will create flexibility and try to be responsive to the business needs of the client in order to make that work.
Yeah, and one way that we've looked at it, right, is it's not so much that what we're doing is always directly comparable to a traditional bank loan, and therefore, is our pricing high relative to a bank loan? It's really For us to be effective, it has to be competitive effectively with the owner's equity cost of capital at the end of the day. And that's really where, if we can add value there and come in, let's say, below what their equity cost of capital is, then there might be something, that's works for both sides. But it's not exactly the same thing as just a senior bank loan, typically because of higher LTV or other structural elements. So I think it's really, as we look at it, the banks aren't so much competitors, they are potential, collaborators and sources of deal flow. It's really the owner's equity capital and that we're, in one way of looking at it, competing with or being compared against.
Thank you. Do you have any charter requirements for your financing for the borrower or any other restrictions in terms of trading? Can you elaborate on that?
Well, as a starting point, it's kind of deal specific, right? So we've transacted with vessels that are trading spot. We've transacted with regard to vessels that are on long-term time charters, and we've transacted with vessels that are on medium-term time charters. So it really just kind of depends on all the overall elements of the deal.
We have no particular policy requirement there. As Joe says, it's very, very transactional. What we're interested in is the break even of the financing and how that compares with what's in the market. And where spot markets are low, can we see visibility on the liquidity support that will allow that transaction to survive to maturity? We are not there to pick up distressed assets and flip them. We want to do right way facing new business, and we want the deal to run to maturity. So the liquidity support and the capital support to bridge that gap into the market is most important, rather than demanding that an owner lock themselves into a low charter rate environment early on in a transaction, which doesn't really serve anybody's benefit.
And at the risk of potentially oversimplifying, I often find, analogies can be potentially helpful in describing it. And I tend to think of us more in the, custom suit business, more so than even made to measure or off the rack, right? So these are situations tailored to the specific circumstances of our clients.
Thank you. Thank you. So let's say from the perspective of the Greek market, where a great deal of ship owners are independent owners of 5, 10 vessels, and they have a hard time obtaining a traditional ship mortgage from a bank, you seem to be an alternative or the best choice, I suppose, for debt financing. Of course, not a blank check, but you offer flexibility, your decent LTV, and no strict restrictions, covenants within reason. So you offer an alternative to traditional ship financing, ship banking finance.
Well, I guess what I would say to that is, just as a starting point, there's no particular, owner size requirement. And in terms of transaction size, we're happy to consider, a single vessel transaction all the way up to fleets. In terms of, covenants and other parameters of the deal, again, it really will depend on what is the ultimate bargain that's struck and the risk kind of return profile that works for both sides. So I'd really welcome a dialogue. I would say there's not really, I can't point to, just one thing that works, right?
Thank you. I think our time almost runs out, but I think we got a general idea of how a credit fund and non-regulated lending facility works. If there are any questions from the audience, would possibly answer?
So we have loan applications just on the side of it.
Come and talk to us. We're open. We want to do business.
Thank you very much, Nick, Joseph. We do appreciate your coming here from UK and the US. It's been a pleasure, and we'll pass it to Yuri for the last panel. Thank you very much.
And Basil, thank you so much for having us.
My pleasure.